Hello and welcome to On the Record, where we go behind the headlines for hard-hitting analysis with the experts. In the words of J.R.R. Tolkien in his Lord of the Rings, all that is gold does not glitter. Not all those who wander and wonder are lost. Yet this week, with bullion falling out of bed to the tune of some 20%, many are lost for words when it comes to offering a rational explanation for yellow cake turning sour. Yet many buyers are in a buying frenzy. From Indian bazaars to Chinese malls to the Pitt Street offices of ABC Bullion, there you have it. Those queues are something to make your eyes water, are they not? To even across the continent over to the Perth Mint, many seeing the plunge as a buying opportunity. It's keeping gold away from that $11.50 an ounce so-called marginal cost of production danger level. What's really going to happen next, though? Well, I'm joined in studio by ABC Bullion Chief Economist Jordan Alizio and the Chief Economist at NG Farah, Peter Maguire. Familiar face, the latter. Jordan, to you, a new commentary opportunity from you, so I appreciate you coming on the show.
Pleasure.
This is what they were queuing up for. This is what? This is $43,000.
That's right.
Or thereabouts in my hot little hand, which is quite phenomenal. And they're buying not just that, but they're buying this as well.
Absolutely.
Little Sister Silver, which, the weight difference is telling. What are we looking at there?
Absolute record quantities of silver and gold flying out the door right now. We are sort of seeing 5 to 6 times our regular trading volume. It's been like that from Monday morning after the original plunge which occurred on Friday over the US, and volumes have just picked up across the week, even though we've had quite a nice bounce in the gold price over the last few days, up to just about back to 1400 US.
People have been trying to construct a narrative, some rational explanation for why, because in the intro, that rally in the last 12 years essentially has been unforgiving. It's
Absolutely.
been one-way traffic, so you've done nicely if you were in on it from the start. What, in your mind, happened this week to change the game?
Well, just one thing why you've done so nicely. If you think of the S&P 500 was in 2000, that market's up about 2%, whereas gold's up 450% in those 12 years. So I think people have got to get into some sort of mindset. There are futures traders, there are physical traders, and what's happened, hedge funds have liquidated positions. A lot of the futures traders in the derivative market have actually been hit with margin call, and there've just been a cascading event of just closing out position after position. But when you close a position, Carson, you need a buyer on the other side. And if there's no buyer, eventually you get to a floor, and that's what was evident over the last week or so.
I think there needs to be some perspective of that. The sheer volume of paper gold that's been traded just on Friday and Monday alone was something to the tune of $150 billion on the COMEX alone.
Currency-wise, are you referring simply to trading it in US dollars?
Yeah, that's the US dollar value. Now, that $140 billion is more than the total value of all the gold that will be mined across the entire year. So it's a clearly unsustainable amount of paper that's all been sold in the last few days. Absolutely cannot dominate the trend for any great length of time, though.
The US Fed, sticking in the United States, we got minutes from their last meeting where, if anything, it showed a tapering off sooner than expected of quant easing, of more money printing. Is that, to your mind, alongside the Bank of Japan's positioning, one swing factor to kind of attribute to all of this?
Carson, I think it's very important to remember that it was only in December of 2012, so only 4 or 5 months ago, that the Fed actually more than doubled the amount of money it was printing in its QE program. Now, if they really thought the economy was going to recover by the end of 2013 and they could cancel the QE, why double it only 4 months ago? Not only that, in the last 5 months, if we look at the real economy, not only in the US but all around the world, Japanese industrial production off 10%, Spanish home prices off 10%, US retail sales and employment figures absolutely terrible. There is no credible way that they are genuinely going to withdraw any form of quantitative easing.
Well, we are stuck, as Ambrose Evans-Pritchard said in the Telegraph, in a global trade depression.
Exactly.
Clear from what you're saying there. But Pete, mindful of what the Fed's been saying of late, back in February, warning that the longer QE continues, the harder it's going to be for them to extricate themselves. I mean, they're wiped up several times over once those borrowing costs go up, which they must.
Well, they must, but there's also the other side, that if you own the money and you keep on printing it and you own the presses, then it could be just a long-term horizon of just absolutely low interest rates for the next 10 to 15 odd years, and hopefully, and that's what they do, they hope to get out of this in 10 or 15 years. The only way you get out of it really is population growth and more people spending and engaged.
You're not really getting that in the US?
Well, no, but the new world, certainly.
The developing world.
And I think that's why gold is likely to be in a bull market for so much longer, because if we keep interest rates low for the next 10 or 15 years, and there's a very good chance we're going to have to.
Well, let's bring up your chart where that kind of underscores it, because the US debt story is, in black and white terms, pretty shocking. Well, there it is for one, but I think we can also flick over, you know, in real terms to see what they are carrying. The third chart as well, if we could. There it is.
Yeah,
the government debt.
That third chart there, what that tries to show is just why we cannot really ever allow a normalisation of interest rates. And what it shows is the amount of debt the US government has today is about 16.7 trillion. Based on the interest rate they're paying on that debt, 16% of their tax revenue has to go to merely servicing the debt. Doesn't pay a dollar back. Based on the amount of money they're likely to owe by the end of 2017, if interest rates were merely to go back to 6%, which is about the long-term average, then they would be spending something towards the tune of 46% of tax revenue just in interest on the national debt. That's not paying for any social security, any Medicare, any Department of Homeland Security, infrastructure. There's absolutely no way that they could do that in a more normalised interest rate environment. And the only way that they can try and keep rates down is by continuing to allow the Fed to monetise the debt.
Pete, into the mix as well, we've got not just the paper market, but we've got physical buying, as we've alluded to.
Yes.
Also coming via the electronic ways and means of a very fast moving
24-hour-a-day economy. Yes, absolutely.
Tell me about that, how it complicates the picture.
Well, think about the derivative side of it and retail, and you've got a population base going from 7 billion today to 9.5 by 2045. And with the information so transparent that everyone is very much aware of what's going on out of an iPhone all across the globe. So there's no secrets anymore. The next part of it, of course, is with the population growth, you have exposure to the markets. Now, these markets trade nearly 5.5 days a week, 24 hours a day. So there's huge volumes and huge liquidity. So there's no chance of getting caught out like the FX market, which is just monstrous. And then you've got financial betting, and that's going to be the next frontier. I can see it now. You're going to see, we talk about sports betting, you're going to see financial betting, and it's in England now, it's across certain parts of Asia, and we're going to see it very much on our doorstep over the next 12 to 18 months here. So everyone's going to be involved in these markets.
And Jordan, that affects those who've queued up to buy the physical gold. How are they likely, a lot of them unsophisticated investors, to treat those wild gyrations? Yeah,
look, I don't know that I'd necessarily agree that they're unsophisticated investors. I think they've been...
Well, versus institutional, just for the sake of labelling them, they're not the hedge fund part of the market.
That's very true, but that hedge fund and institutional market has, in many cases, completely ignored the 400 to 500% rally, whilst these, as you say, unsophisticated investors have been participating for many years. So they are all acknowledging and are aware that this sheer volume of paper that's being traded clearly does and will continue to influence markets over the short term, but it will not change the fundamental direction of any bull market or bear market for that matter. And they're seeing a huge opportunity to pick up more physical because it's on sale right now with where the prices are.
What happens when the physical demand does not match what's actually...
the paper demand?
Well, this is it, because you look at the miners and their marginal cost of production, but more importantly, their performance. When we last saw bullion at these levels, our biggest miners were trading thrice what they are now, in many cases. Explain that, Pete.
Well, it's damn hard. I mean, you're looking at, consumption. You think about what BHP was. I can't work out how it's Australia's largest company, 12% of the market approximately, and 2 months ago today, it was at $39 an ounce, $39 a share. Today it's under $31 or close on $31 in 2 months. So that's huge volatility, and of course what's happening in the China picture. So if that starts to slow down or continues along that slowdown process, less demand, then that's going to certainly crimp a lot of these other miners.
I think there's an incorrect thesis out there, though, that gold is a bubble and what we're seeing now is the end of that. So it's actually in many ways not surprising that those that would believe that thesis have sold the miners in anticipation of a falling gold price. Now, I believe that, for me personally, I prefer to own physical gold than gold mining stocks, but I do hold gold mining stocks in my portfolio. for them to have just incredible upside over the next 5 years is clearly there, because they're the ones that are ultimately going to be pulling this stuff out of the ground.
Well, and yet that's becoming harder and harder to do. They're having to go deeper and deeper. Newcrest even just recently had to massively scale back its production forecast.
100 years ago, you could get 20 grams a tonne out of the ground. Now you're lucky if you get 1 gram a tonne. So, you know, gold, the easy gold has been found. There's absolutely no question.
The easy oil's been found.
Correct.
Hello, shale.
Yeah,
as a result.
That's right. We don't have another answer for gold, though.
I mean, that's the difference between oil and certainly gold. Oil, we're looking at new frontiers as far as new energy sources, from solar to wind to thermal to, nuclear, you name it, across every framework, and naturally shale and then natural gas. With gold, that yellow stuff there, there is no substitute. So I think that's going to certainly underpin the price over the coming decades, and it's going to be interesting what the actual headline's going to be.
Scott Phillips from the Motley Fool, who's a regular on this channel, is of the view that you want to be buying when it's almost unprofitable to mine for more gold. That would imply another perhaps $200 to the downside. Convince me, Jordan, that is unsound, and buying this week was sound.
Look, I don't think that you could totally write off Scott by saying that there's no chance prices could correct further. And obviously, all of us would love to buy at the absolute bottom. But by definition, there can only be one of us that will do that. The way I look at gold, where it's priced right now, there's maybe 10 or 15% downside. But as long as we keep printing money and as long as we keep interest rates low, which we will for years, the potential for upside is many hundreds of percentage points. So when you look at trying to allocate capital in an environment like this, and you look at the risks in the share market, the risks in the bond market, the fact that you earn absolutely nothing in the bank effectively after inflation and tax, then
you're treating it inherently like an investment, and many would say this defies all investment logic, Pete. To hold gold, you cannot overlay those traditional kind of metrics.
Earn a yield. But the yield it earned is 450% up since 2000, whereas the S&P is up 2%. Sure, it's kicked off some dividends on the way, but that just showed you the true value or the intrinsic value of the particular precious metal. There's no substitute for that. The numbers don't lie.
And a 10-year US bond right now is yielding you 1.5, 1.6%, which is less than inflation. So the opportunity cost of gold is negligible in this environment.
Yeah, see, you think of US dollars, and certainly, and that's what everyone's on the mindset of, and yes, it's had a big correction, but people aren't mindful that the Japanese yen has depreciated 25 or 28% in the last 6 months. So in Japanese yen, gold is at a record high. Now,
and that's the thing, it's not just a
US dollar play
at all.
Have a look at rubles, have a look at the Russians, have a look at Saudi Arabia, have a look at what's happening in India and China and all through Asia. So currency fluctuations are very much a part of the whole mix, and they need to be taken into context.
Tell me about the inflation hedge backdrop, because that had always been rolled out, trotted out as justification for yellow cake going up.
Sure.
Where are we at on that front? At what point does that trigger yet another class of investors?
Well, I think
when it does present.
I think what we've seen over the last 5 years with, since the GFC and quantitative easing entering the financial lexicon, we've seen this huge amount of money that's being printed, but it hasn't really gone out into the real economy yet. So that's helped to constrain inflation a little bit. Once that money does start to seep out, though, we're going to see inflation pick up in a very meaningful way. And as I always say to people, if the threat of inflation can force gold up 500%, imagine what real inflation is going to do to the price.
Do you have a sense what that moment in time will be? What are you looking for?
I think people will really start to pick up into gold once it gets back above 1600 and once inflation gets above 3-4%. And I think real inflation's already there. I think the sort of currently adjusted versions, we might be a couple of years away from seeing that.
Pete?
Energy prices, if they stay under $90, which I don't necessarily think they will, that's where we need to look at probably $75 to $80 an ounce, a barrel. But I just don't see any chance of really that existing unless we see a massive deflationary experience, and that would be a sell-off of all asset classes, gold included. But for that to happen, then the whole mindset of just keep on printing.
Just keep printing.
Exactly. They're not going to change, and we've got already at 400 and 500 year record low interest rates across France, Germany, Holland. So 200 or 300 years as far as England and France.
And yet the threat of deflation is everywhere.
Yeah.
And heaven forbid on our very doorstep.
In the last
So,
48 hours alone, whilst you talk about the minutes of the Fed talking about ending QE or scaling it back, in the last 48 hours alone, we've seen 2 Fed governors come out and say interest rates might need to stay low for the next 10 years, and we might actually need to start increasing the size of QE.
All right.
There's no question that they will keep printing until we get inflation. By the way,
the era of money printing is young yet. Gentlemen, thank you so much.
Thank you,
Appreciate
Thanks very much, Carson.
Jordan D'Alicio there from ABC Bullion, their chief economist, Jordan D'Alicio, and Angie Farris, chief economist.